Good evening, ladies and gentlemen. We are going to start the webinar in a couple of minutes. As people join, just give us a few more minutes and we will start. Thank you. Good evening, everyone. Welcome to our webinar, Beyond the Bounce Back. We are here today to take stock of what has happened in the markets over the last couple of years and what we can look forward to in the year 2022. We have two extra special guests with us tonight. We have Dr. Jens Wechter. Jens is a senior global macro and research analyst at Templeton Global Macro. In his position, Dr. Wechter analyzes trends in global fixed income and macroeconomics and has a regional focus on Europe. Welcome, Jens. Also joining us today is Faris Benouari. Faris began his career at UBP in 2006 as an analyst for the European small and mid caps and the global industrial sector. He also had portfolio management responsibility with the team and contributed to building the existing Swiss and global equity franchise. Welcome, Faris.
Thanks for having us. Hi.
We also have our very own Continental Group's Neelam Verma. Neelam is a seasoned finance and banking professional with over 20 plus years of experience across investments, private banking, and wealth management, corporate and commercial banking, real estate finance, retail banking, and Islamic banking across India and the UAE. I hope I covered all of that, Neelam. Welcome. And I'm looking forward to this session. I think we have a lot to learn from all our panelists and looking forward to this.
Thank you. Thank you, Abhishek.
Before we start, we would like to go to a poll. Can we have the poll on screen, please? So the first question of the day is, which of the following would influence your investment decision making in 2022? Would it be inflation, interest rate changes, the impact of climate change, geopolitical risk, or energy transition? Please vote while we continue the webinar. So Neelam, while people are voting, can you give us a brief idea of how the markets have performed? And how has the year been for Continental clients on fixed income and equities?
Certainly, Abhishek. I recall last year when we hosted our very first webinar, and we were all discussing what happened last year in 2020 and what is the outlook for 2021. We saw that 2020 was set to be among the worst years for the global economy in over, I think, 70 years. Everyone was expecting that the US economy will shrink, which is what happened last year. Developed markets, emerging markets, China, everyone contracted and saw a big slowdown. We were very optimistic about 2021, and I recall saying that time and again that 2021 will see a lot of pent-up demand come back and global economy bounce back. And that's exactly what has happened. Global economy has bounced back strongly from the pandemic-driven growth or slowdown, I would say that lasted last year. I think the pace of recovery has still remained uneven amid a surge in different COVID-19 variants. Somewhere slower rate of vaccinations, major countries, developed countries seeing a very good traction on vaccinations. At the beginning of the year, a lot of uncertainty loomed high. as we saw the pandemic was still on the rise. So this webinar is all about what happened last year, this year, and what is it that we expect the following year, which is 2022. Beyond the bounce back also means that we've seen bounce backs happen across economies, setbacks happen. Things were, as you can see, the entire image that we have is there were a lot of collisions that were happening, which was impacting the world markets. And that was due to the fact that COVID was resurgent in some places, while in some places it was actually under control. It was also estimated that the US economy would continue to shrink and report a negative growth as it was last year. China would see a contraction. India would see again a contraction because of the spike in the COVID-19 cases. Surprisingly, and this is how we were expecting, US has seen a growth, and the growth rate has been around 6%. China has grown at about 8%. India has grown at about 9.5%. And the World Bank estimates the global growth rate at about 6% approximately this year. What are the reasons behind this? I think the key reason is active monetary and fiscal policy management by key central banks. We saw a lot of negativity about vaccination. I think vaccination rollouts played a major role. And many economic packages were announced by a lot of countries. The pandemic also made a major change. The change was that the world became more local, more digital. It was much easier to connect. Most companies adapted to the new digital way of work. And as we know, 2021 was all about technology, financials, healthcare, and a lot of focus also on energy and ESG. So in general, if I look at the continental clients, our clients were actually very ready because we've been a key follower of asset allocation models, diversified portfolios, maintaining risks, actively managing our clients' and investors' interests. That has helped us. So Continental generally had a very good year this year for our investors.
That's good to know. Can we have the results of the poll, please? So this is quite interesting. We almost have a tie between interest rate changes and inflation as the two biggest concerns for clients when they are making investment decisions next year. So following up on that, I would like to ask Jens, what do you think were the major factors behind this market rally in 2021? And what do you think is going to change in the next year or so?
Yeah, that's obviously a very good question. In particular, not so much what happened this year, but what's going to happen next year. So I think for this year, what has been behind the rally, more on the equity side, but less on the fixed income side, is that we have had a strong rebound in growth, and we had continued support from the fiscal side, from government spending, and also from the central banks, which just kept on buying pretty much every bond that was out there. The US government or the US central bank, the Federal Reserve, is now starting to lower that pace of purchasing, but this is something we may discuss a bit later. The ECB continues to buy. They are running up on all kinds of sort of ceilings that they set themselves in not owning more than 50% of government bonds in the euro area. The Bank of England has been buying, other central banks have been buying. So this was extreme liquidity support, and lots of this liquidity just went into equity markets. And as Nilam has already pointed out, there were reasons to buy certain technology stocks or healthcare stocks because they have been in just high demand. The flip side of that was we had inflation was rising. People, because of the high growth, people have been worried about generally rising interest rates. They have been worried about what central banks may do going forward, and so turning our attention towards next year, I would think that there is gonna be a little more headwind coming our way in terms of both the fixed income markets, but also the equity markets. We would probably see a less looser monetary policy. We may even see tight monetary policies in some countries. We will see a whole lot less of fiscal stimulus from governments. Some governments have to be very mindful of their debt and may even have to tighten monetary policy so that we get not a fiscal stimulus, but a fiscal sort of detraction in terms of growth. And rising interest rates is bad for equities. Maybe not if they rise only a little bit, and sort of the business cycle environment is still good enough for equities, but it is certainly not good for fixed income.
Thank you, Jens. Faris, I would like to get your thoughts on the same.
Well, a lot has been said already, so I'm just going to try to keep it short and punchy. From the equities standpoint, the main driver for the market rally this year was earnings upgrades. You may remember that in January, consensus was expecting 30%, 30 EPS growth for global equities for the MSCI World. Well, now in November, as we stand, we expect 50% EPS growth. So you see how wrong the consensus has been in January, and we were also too conservative about EPS growth. Nilam has already elaborated around the reasons why such upgrades may have happened, notably around the economic recovery, the broad access of vaccine, especially in developed markets, but probably also more efficient than what was initially thought and more readily available. So that really helped the global environment for equities. It's true that it's fully supported by the quarterly seasons that we've seen with a majority of companies, 80% in the US of companies beating on EPS, almost as much on sales. So 3/4 of beat and raise in a row. And if you look at companies' guidances, and I will keep that perhaps for when we talk about the outlook about 2022, but the guidance for this quarter were really positive. 65% of companies who guided up their midterm outlook. So rather a supportive environment. Agree that there are headwinds. Agree with Jens. Lots of headwinds piling up and clouds coming over our heads. But still a constructive view for next year, which we will have time to elaborate around. I may just add one thing about the reason for this rally in 2021. Not enough has been said, I believe, about the productivity gains that companies have made through the pandemic. We know about work from home, about saving costs related to travel, to office space. We hear a bit less about automation in factories to address staff shortage. We think this is a story that is going to continue to play out in the coming years, and productivity gains are sticky in our opinion. So that's what I can say about 2020 and 2021.
Right. So, I think all the panelists mentioned a little bit about money supply and inflation. So keeping that in mind, we would like to go to our second poll question for today. So the second question for today is, what direction do you think inflation will take next year? Will it go higher? Will it go lower? Or will it pretty much stay the same? So Jens, I would like to ask you about inflation. I think everyone's first concern today in the markets is how inflation will affect their portfolios. How will it affect fixed income? I want to get a more, clear view of where the inflation is coming from. Is it supply side? Is it from the demand side? Is it in goods, or is it also in services at the moment?
Inflation is, I think right now it seems to be driven by both factors. So it's both demand side driven, but also supply side driven. For looking at the demand side first, what happened is in last year when many governments, in particular in the rich world or in the Western world, supported their workforces by sort of supporting them by stay at home and giving them money, for those through the furlough schemes. That what happened is that the disposable income, so the after-tax income that households had, did actually not shrink during the pandemic, even though many of them did not work. However, people could not spend the money because they were locked away and at home, right? And so what happened is that savings went up, and savings have been rising quite strongly. And so in many of those countries, now households sit on a large pool of savings. Economists call this excess savings, so it's beyond the ones that they wanted. But now the question becomes, is this going to be spent in its entirety, or is it going to be spent just part of it? So what we are seeing now is that with the opening up of the economy in the earlier part of this year, a lot of this pent-up demand and this was sort of released on the market. So households had the money, they had the funds, so they could go and spend. Initially, during the pandemic, a lot of the spending was on goods because services were so constrained, with hospitality and the tourism sector pretty much closed down. And now we have seen a little bit a move away from goods, but towards the services sector now that the economies have opened up. So that's sort of the demand side of the economy. Now turning to the supply side, we have, with the closing of the economy in last year, and then this reopening, there was so much stress on the supply chains that many firms canceled their orders. Then all of a sudden the economies opened up again, and then they had to put in new orders. Suppliers had to fill their capacity with other things, and now sort of this surge and all of a sudden in demand coming from the corporate sector on certain suppliers has led to shortages or stress in supply chains, which worked seamlessly prior to the pandemic, but have been sort of thrown out of sync because of that standstill, and then sort of basically a full break, and then a strong acceleration. And we have this, for example, that I was just the other week, I was in the US, and I was hearing a report that in the port of Los Angeles and Long Beach, which are the biggest ports in the United States, they just have a surplus of containers. And first of all, they don't know where to put them. They're all empty. And second of all, they can't get rid of them. Now there's a shortage of containers and on the other side of the Pacific in China. So this is sort of a fallout from the pandemic. Similar, what we know is, say, if planes are grounded, then they're in the wrong spot because there was some kind of natural disaster, so they couldn't fly, and so it takes a while for them to get sorted out and get to the right destinations. And that's the same thing that we're observing right now. So inflation is being driven by these two factors. So they're both, supply cannot adjust quick enough for the strong demand. Now the question towards services and goods, it has been before that it was services that was lagging and goods were rising a lot. Now what we have seen is that services continue to accelerate, still lagging goods. So goods prices are still rising faster. From what I observe is that services prices are, however, very closely tied, at least from what I've seen, where the most increase is in prices that are related to the hospitality sector and the travel industry, or certain transportation in the widest sense. So this seems to be still tied to the opening up, but there are no wider fallout on the services side that we will see already second round effects, that we have services sectors in general demanding higher wages and so forth. So this is not the case yet, at least that's not what we're seeing in the data.
Right. Before we go to the next panelist, can we have the results for the poll, please? So 74% of our audience thinks that inflation will be higher next year. So that leads me to ask, that where do you think inflation takes us from here to in the markets? How does it affect the markets, and how, Faris, do you think that it will affect clients' portfolios?
So first of all, I'm not an economist. I'm a portfolio manager, so I don't have a sophisticated view as Jens. However, I beg to differ from your audience viewpoint. We see lower inflation next year. We don't see a world where inflation will remain at 6%. We see a world where structural forces are rather pushing for a 3% inflation over the long run. That's driven by such forces as, for instance, demographic trends. I know I'm diverging a bit from the supply chain consideration that everybody has in mind, but we like to also see beyond that challenge, which we believe will be sorted out next year, rather in H2 than in H1, by the way. But the structural forces for long-term inflation for us remain the same, and they are rather pointing towards a lower inflation. So it's demographic trends, especially in developed markets. These also are internet platforms, which bring lots of price transparency and price deflation in tons of services that you can think about. Think about companies like Amazon, Netflix, Spotify, or Booking.com. This is actually bringing prices down and more transparency for tons of services, and this is expanding to new areas in our view. So that force remains. I mentioned automation of manufacturing earlier, so I think this is also going to bring productivity gains and lower operating costs for companies going forward. And generally speaking, the productivity gains we made with COVID, work from home, video calls. I traveled more than half less than last year, if I just take my own example. Meeting more companies than I met before the pandemic, so not losing any efficiency there. So I think those productivity gains that technology brought with it will be sticky and rather push for a world of inflation at closer to 3% than 6%. And if you now ask me what we think for next year, well, our economists at UBP sees peaking inflation in developed markets early next year, and a bit later in developing markets. So we see peaking inflation behind us in H1 already of next year, and then falling back to close to 3% on the basis of comparables. And I think it's important to remember that we come from a very low base in terms of inflation last year. So if you look at the 2-year stack of inflation, it's closer to 3% than the current 6%. So you have to also lap this 2020 base effect. So all that to say that we are a bit more constructive regarding inflation. We think that supply chain is an issue, is a challenge, but that capitalism will work eventually, moving capital where it needs to be moved, and that companies will sort this out in the second half of next year, almost forgetting about these headlines.
I think, Faris, you highlighted a very important point that there was a world before the pandemic as well. That we have structural forces at work that we have kind of forgotten about because of the pandemic. So keeping that in mind, and there's something very interesting you mentioned about technology and the disruptive technologies that have changed lives and productivity gains that it has led to. Neelam, would you like to shed some light on what your views are on that?
Sure. I think Jens and Faris have more or less covered all the points that we could think of when it talks about inflation. To me, inflation is the rising cost. A lot of households are facing that brunt today. While there are savings, like Jens said, huge amount of savings that have piled up, and those savings are waiting to be deployed somewhere. And I think the current year that we see is going to close up with that high inflation rate. Next year, as we said, is going to continue with that high inflation. Things are going to get adjusted over the next second half. That is what we hear and we believe in, given the fact that supply chain disruptions are going to be managed better. It's a little too early for us to say, because what we see recently is that Europe is going through again a second resurgence of COVID wave. Russia has been seeing huge numbers again on the COVID side. China has seen another lockdown. A lot of large economies, while they have maintained the vaccinations, but they're quietly seeing those numbers inch up. So we really don't know, and it's very difficult to predict how inflation will pan out, given the fact that there could be a setback that COVID can come back with. Having said that, I think the governments are working really hard to make sure that inflation cools off, the concerns go off. A bit of interest rate increase would help, I think. I think markets have already priced in all these interest rate changes, and companies are geared up to maintain those earnings next year. So while we look at inflation at this level this year and maybe the first half of next year, we'll see a little bit of cooling off in the second half of 2022.
So Neelam mentioned a very interesting point about increasing of interest rates. So Jens, I have the question for you, the one that everyone wants to know. Should the Fed taper or should the Fed increase interest rates? Where do you think it's heading? Because the feeling generally is that the Fed today is struggling to find the right balance between tapering and increasing interest rates. So do they decelerate? Do they put the brakes on the economy? What are your thoughts on the same?
I think we have to sort of address the issue of in which way, or so they call it the sequencing of how they proceed. So currently, if we're talking about tapering, so for if maybe I'm not sure if everybody knows exactly what that means, but what the idea behind this is that the in terms of the Federal Reserve, that they will reduce over time the amount of securities that they are buying in the open market. So that's what they call tapering. And I like to compare this with, say, the accelerator pedal of your car. So when you push the pedal, and the Americans have this rather sort of nice phrase, so that they call push the pedal to the metal. So if you push it all the way down, then your car accelerates very quickly. However, if you just release a little bit, then the car will not stop or will not decelerate, but it just will accelerate at a slower pace. So you still accelerate even though you don't push the pedal to the metal. And same is sort of the tapering is the similar effect. So they may reduce the amount of purchases, but they are still buying bonds. So that means they're still adding liquidity to the market, just at a lower rate. And so that right now, the Fed is buying, just to give you some numbers, they are currently buying in every month 105 billion US dollars of securities. And they have said that since beginning in December, they will reduce this amount by 15 billion every month. So that means in 6 months' time, so at the end of May or early June, they will stop their bond purchases. So that sort of, in that sense, then they would have the accelerator to that level where they can maintain their pace. So then comes the second question: when will they raise rates? So first of all, they're sort of withdrawing some of the stimulus at a lower rate, but raising rates would then mean they would definitely trying to slow down the economy by increasing interest rates, which means they will depress demand a little bit because they will make loans more expensive. This will also weigh on investments, of course, because borrowing funds will become dearer. So that's the idea. But first of all, it's the tapering, sort of that withdrawal of buying additional bonds is one thing. Raising interest rates is the other thing. So the first thing is sort of getting away from boosting the economy, and the second step would then be breaking the economy, slowing it down so that the inflation rate over the medium term, because that's the target that central banks always have, they can never influence the current rate of inflation. So I tend to say that the least important data point is for a central bank is the current rate of inflation, because it is nothing that you can do about it. So it has to look for the longer term. And so the purpose is to slow down the economy so that over the longer term, inflation goes back to its target. And that's sort of the second step here.
Thank you, Jens. I just want to let the audience know that if you have any questions for our panelists, please feel free to ask. And yeah, so before we go further ahead, can we have the next poll question, please? Sorry, I was on mute. So the next question is, what are your thoughts on investing right now? Is it the time to be conservative, aggressive, or would you rather adopt a wait and watch strategy? So while the audience answers the question, let's ask Faris. Faris, what are your thoughts? Will growth continue to outperform value? Will technology be the consistently growing factor next year in the markets as well? Please feel free to let us know what your thoughts are on that.
Well, that's a good question. It's true that growth has outperformed value for the past decade at least. So it's a legitimate question to wonder whether this is going to continue. But few people noticed that value has outperformed growth already in 2021. So it's not totally true to say that growth is still outperforming and has market leadership. We see it a bit of in a different way. You know, we don't do style investing here in the Swiss and global equity franchise. We think it's extremely difficult to anticipate which style is going to take the lead in any given year. So I'm going to try to introduce you to another style, which is value creation. I think that value creation, which is not a traditional style, it's actually the quality of the companies measured by their cash flows. This value creation style outperforms all the others consistently over the cycle. And that's because when you think about the company's operations, they are best measured by their cash flows. So if you manage to find companies that generate value as measured by their cash flows, if you manage to accurately predict where the cash flows are going to be in the coming years, then you have pretty good chances to also predict where the market is going to go. So for us, more important than whether growth or value is going to outperform is rather to continue to find these companies with a high value creation measured by their cash flows. And now I don't want to dodge your question. What's my view on growth versus value? I personally struggle to invest in value over more than over a quarter or so. I think that value outperformance is not structural by definition, because if you look at what are the type of companies that constitute the value style, they are very often value destructive companies, in fact, as measured by their cash flows. So we're not surprised to see that over the past decade and more, value has tended to underperform, even if it's always tempting to say, I'm going to buy the cheap PE companies, I'm going to go for the undiscovered value out there. The reality is that the aggregated value index is really made out of these value destructive companies who typically underperform. So I wouldn't put my eggs in the value bucket next year. I would rather try to find value creative companies. And if you are rather following the traditional canvas, then probably growth has better chances than value. I hope this answers your question.
So as a follow-up to your question, so if you had to pick, what would be the major mega trends, as they are called nowadays, next year that you would follow? Would it be disruptive technologies, zero carbon emissions, anything in particular that you think would be a standout theme for next year?
I mean, there's nothing totally new in the mega trends that we follow and that we get exposure to. If you think about ESG, for instance, there's a lot of discussions about how many fiscal stimulus will go towards ESG projects. So of course, we tend to try to get the companies who are on the positive side of the equation, benefiting from these stimulus packages, and avoid the companies who are high CO2 emission companies, for instance, because so far they get away with their emissions, but it's like, you know, a Damocles sword above their heads, which may fall one day or the other as regulation goes tighter. So ESG as a theme, we tend to try to get more exposure into that one. Also, I mentioned twice already manufacturing automation. So we like especially software automation, industrial software automation names. We think that's a thematic which will gain in importance. And you will all have noticed that payment is going through a little revolution this year. It used to be a very strong performer in 2020. And we believe now that the market is going to segregate between the winners and the losers. So you have to be very careful in terms of which stocks you buy in the payment space. There will be lots of winners, but also lots of companies who will lose market share and perhaps even disappear among the legacy companies. So these are just three themes I can think about right now that we try to get exposure to and do start picking within these themes. But generally speaking, all the other themes, we like them, and we tend to be multi-thematic and not monothematic when we invest in equities, just because this can also be very trendy and sometimes a bit out of touch with reality. So we like to have this multi-thematic approach when it comes to investing.
Thank you, Faris. Thank you for that. Jens, what's your view on fixed income? What are the trends that we will see in 2022?
Yeah, the trends we will see in 2022 is very difficult environment for fixed income, I would believe, going forward. We are generally in an environment where growth is likely to slow from the heady pace that Nilam already pointed out that was projected for this year, but because this is an unsustainable pace. This is a recovery. This is a classical V-shaped recovery that we see. So next year will be still solid growth, but lower than this year. So that means inflation may come down a little bit from what we are seeing right now, and I support Faris' analysis on that. Just to remind the audience, inflation is the rate of change of prices. So how prices change from one year to the next. So say if the oil price goes from 40 to 80, we would have 100% increase. If it stays at 80 for the next year, we would still pay higher prices at the pump or for taxi or so, but the rate of change would be zero. So this is sort of a natural thing. What happens when you calculate the rate of inflation, that it's a change. So that's why inflation, we believe, is coming back. Prices stay high in general, but the change is coming back, and that will just weigh on fixed income. Central banks are most likely to tighten monetary policy going forward. So this all leads to higher yields, and that means capital losses on bonds that you have in your portfolio. And I think only two ways to sort of, I don't want to say survive the year in fixed income, but sort of to have any kind of chance for a positive return is if you have assets that pay you a high coupon, and that the sort of the carry that you earn on the coupon is higher than the loss that you will take from rising interest rates on your value of your bonds. That would be one part. And the second part is, and many fixed income investors are very aware of that, you have to look at the sort of the currency in which you are investing. Say if you are investing into international global bonds, you can always invest into countries which have a chance of capital appreciation through rising exchange rates, sort of an appreciation of the exchange rate, to be more precise. So that would be something that could add to your fixed income return if you were to pick those countries that would see or benefit from rising interest rates, rising growth, because they would have capital inflows that would then lead to an appreciation of their currency. But other than that, I would think fixed income in general, in particular, if you go to the developed markets, you're just in for losses.
That's interesting, Jens. Thank you. Before we go to Neelam, can we have the results for the last poll, please? That's a pretty even split. A lot of people are willing to sit out and wait and watch. A lot of people are wanting to be aggressive. And there are people who would still invest but be conservative in the stock markets. So that's an interesting scenario. We have pretty even split on that. Can we have the next poll, the last poll for the day, please? So before we ask our panelists this question, we're going to ask our audience. At the end of 2022, the US stock markets will end higher, lower, or around the same level. So while our audience answers that, Neelam, what are your thoughts on the coming year, on 2022? What are the major themes that you want to look at, and what would you have to tell our clients?
Well, there are two parts that I would want to discuss here. First is the liquidity. I will take this opportunity to speak on behalf of the investors this time around. I think we've observed that investors have realized that sitting out and not making a decision on their savings, which is lying in the bank account, is not a great thing. They've realized the significance of investing, and the positive sentiment that we saw this year, or rather the run-up that we saw since April of 2020, has been encouraging. Peer pressure, family pressure, others making gains. All these factors have actually come together to encourage investors to participate across all the market segments. We are expecting that interest to continue in 2022. Talking about inflation, I think, Jens, you picked up a very valid point. We've seen oil prices actually go up. And I would talk about myself here, living in UAE, can see it go high every month. We live in an oil-rich economy. I'm sure in Germany and Switzerland, I would just want to reiterate that Jens comes in and joins in from Germany. Faris has joined in this call from Switzerland. We are based out of UAE. We are from the 3 different countries. We all are getting affected by the increase in oil prices and household items and goods. So inflation is something that we would continue to watch out on. Economic activity will rebound to the pre-pandemic levels. That is what is our outlook for next year across all the major markets. As Jens said, the pace could be a little slower than what we saw this year, because this year was an abnormal year, an outlier in all sense. This is what happened when the Spanish flu was actually at the peak. Consumer demand will continue to recover. It will continue to vary by region and country, again, depending on the health risks, the mobility restrictions that we've seen, possible limitations on government spending, and affordability. Inflation, interest rates, and I think a lot of talk has been going on for universal vaccine, which will cover possibly all variants of COVID, or an oral medication which will cover COVID. Those would be positive factors to raise up and give that boost to the markets, and could be the talking points in 2022. Again, high inflation could strain household budgets, and the slow recovery in the consumer-related sectors, economic growth, especially if the job markets remain weak, which we've seen in a lot of countries, would be the major factors to watch out for. Having said that, I, being an optimist, will remain optimistic about 2022. We would want our investors to start looking at balancing the portfolio. A few months ago, we were looking at markets growing beyond a certain level, and everyone wanted to know, where do we strike that balance? Is this it? Have we hit the peak? But we keep getting surprises from S&P 500. I think S&P 500 has seen more than 260% growth over the last 10 years. And nobody could have imagined such growth. So markets will continue to surprise us. I think what Jens said, fixed income markets would be a sector to watch out for, an asset class to watch out for, simply because interest rates, if we see a major change, a massive change, would get all the fixed income securities a major shift in the southward direction. So my market outlook remains very optimistic. I'm a growth investor, and I prefer growth over value any day. So we'll continue with that the next year as well.
That's great, Neelam. You know, one of the, I think the important word you used is optimistic. And, you know, I believe if to be a successful investor, you have to be an optimist, because that's the only way you will stay invested and enjoy the growth in the long term. On that theme, I would like to ask Faris, what do you think is the best way to invest, you know, in the long term in the markets? You know, the factors like inflation, etc., will always be around, but there is that people can still make money in the long run. And what is the best way to do something like that?
Thank you for this question. It allows me to advertise a bit how we invest at UBP. But allow me to just build on what Neelam just said about the 2022 outlook first. I promise it won't take more than 2 minutes. We are definitely constructive for next year. Global equities, not only US, but for the global equity markets, we try this prediction of 15% return, 1.5. And in order to make this prediction, we break down the performance between EPS growth on the one hand, and the rate of change in the PE multiple. And what we see for 2022 is 15% EPS growth, which compares to consensus at 8% only. So why are we more bullish? I think it has to do with, first, the fact that the sell side has been quite lazy in updating 2022 numbers. They've been quite, let's say, trying to catch up with their predictions for this year, moving from 30% to 50%. But for next year, they're still behind the curve. And what you see now is that 2021 EPS estimates have risen so much that next year EPS has contracted to 8%. So you see negative revisions for next year on the back of this strong growth this year. We think this is wrong. Companies who have managed to deliver 50% will actually continue to enjoy whatever they've done right this year in terms of logistics, operations, productivity gains. And the second argument for being more bullish is a bit counterintuitive, but we talk a lot about supply chain issues. And I told you that 65% of companies who guided for next year guided up. The reason is because lots of demand could not be addressed in 2021. And what's happened is that it's been reported to 2022. So lots of this guidance increase we've seen during the earnings seasons is the result of 2021 demand being postponed to next year. So we think this is going to also trigger EPS upgrades to the magnitude of 15%. And then in terms of multiple change, we think that with the roll forward exercise in January, as you put new EPS numbers in the denominator, you will end up with the 16 times PE on the MSCI World, which is in line with the historical average, not demanding more compression from here. And so with this in mind, stable PE ratio at 16 times and 15% EPS growth, we have good chances to go for this type of return next year. Not in a straight line. We know the risks. We know markets are going to be volatile. But for us, over the full year, this is quite credible to get this type of return. And then I can just support Nilam's view of being bullish for next year. Now, your question, how was the best way to invest? Sorry, it went a bit above the 2 minutes I promised. But listen, we tend to believe that the best way to predict future market performance is not by looking at macro indicators or by looking at snapshot PE ratios or making technical analysis. Our fundamental view and conviction is that if you manage to forecast companies' cash flows accurately in the coming years, then you will have pretty good chances of forecasting the performance of these stocks, markets, and sectors. And I insist on this point. This relationship between value creation measured by cash flow on the one hand and stock price performance on the other hand is not only true for stocks like Nokia or L'Oreal. It's also true for entire markets like Switzerland versus Japan, like India. Perhaps we have lots of Indian investors in the call versus UK. We believe that value creation explains the outperformance of this or that markets. And by the way, it's true for sectors as well. So I'm pleased to go through as many examples as you need. We don't have any market supporting material here, but I think it's quite interesting to realize this relationship that if you measure cash flows accurately in the coming years, you can predict the stock price performance as well. And that's why also we remain relatively more bullish on high value creative geographies like Switzerland, like the United States, Nordic countries. Also, India has a very high value creation, and less bullish on some other emerging markets and Japan in particular. So that's my view about how to invest. Don't try to time the market in terms of styles or sector rotation. Rather try to identify stocks who have a high value creation measured by their cash flows.
That's a very interesting point. I always tell my clients that, if you just focus on the stock price, you will never actually enjoy the value that the company creates. So focus on, if you stay invested long enough, the business will grow and you will reap benefits of that. So that's what, and I completely agree with you. Jens, what are your views 2022? What are the macro factors that we should keep a lookout for? Any thoughts on that? I'm sure you do have a lot of thoughts on that.
Yeah, plenty of thoughts. Mostly focusing though on the fixed income side, and so I've already mentioned that. I think I think Nilam already pointed that out as well. So he's actually good for giving cues here, and we could just add on a little few of our thoughts here. But it's the vaccination and the process and the progress of vaccinations in next year is certainly something that will, for fixed income investors, and especially fixed income investors who are interested in global investing, be very interesting to see what happens and to identify those countries that are managing the pandemic better and being able either to limit the fallout from the pandemic on their economies, keep their fiscal accounts in order, not letting debt run totally out of whack with economic fundamentals. And those countries that will benefit then from the resurgence or the continued growth cycle that has started this year and will continue next year, even at a lower pace, but it is normal given the rebound that we are seeing from this year. So I think this is the critical question that we need to follow. Which countries are really making a strong effort, a strong push to, I don't want to say eradicate, but at least to contain the pandemic within their borders, within their jurisdictions, and their, what they can be responsible for, to that degree that their economies can start growing again. And so that same in companies where there's value creation, same is also in economies where people work. They don't always work for stock listed companies. They are, they're shop owners, they are self-employed, they work for smaller businesses. Most of the businesses are smaller businesses. The majority of people work in small businesses. So this is something that the countries need to address and need to sort of manage. And I think those countries that are good at managing this and understanding this, and this also probably may mean there is no zero COVID, there's living with COVID and constraining the effects of COVID, those countries will benefit from the growth that we will see worldwide. And other countries that struggle will be lagging. And so there you will see the differentiation. And then it comes to differentiating the ones that benefit and all from the ones that will probably lag and continue to suffer.
Thank you, Jens. Thank you. Can we have the results for the last poll? All right, so majority of the audience thinks that the S&P 500 will, or the US stock markets will end higher next year, which I guess is pretty much in line with all our experts on the panel. So before we close for the day, we have a few questions from the audience that we would like the panel to address. Can we have some of those questions, please? All right, we have our first question is, if interest rates are expected to increase next year, will a 60-40 debt equity portfolio still perform? Who would like to take a go at that? Jens?
Since you put me on the spot, I don't want to give the lawyer's answer. It depends, but I think I'll have to, because what I don't expect is that interest rates worldwide will rise dramatically. We have seen in Brazil 525 basis points this year. Brazil is certainly a different case. We have seen over 300 basis points in Russia. But so far, many other countries have either not hiked at all or have hiked 25, 30, 50, 100 basis points. So I would say in general, if rates were to rise gently, a few basis points here or there, I mean, like two steps in the US, two in UK, none in the euro area, maybe one. I think for a bond portfolio, that would still not be dramatic. And for an equity portfolio, given what Faris suggested, I think if earnings continue to grow at that healthy clip, then I don't think that the small increases in interest rates will sort of derail that development in the stock markets. That will depress valuations a little bit because the discount rate increases, but I still think that the basis is you have not interest rates that get jacked up dramatically. The picture would be different if we would be further out in the cycle, and inflation will not recede as much, or inflation expectations, as has been shown in the poll. People have quite high inflation expectations. If that is becoming entrenched, then central banks need to tighten more, and then I would be more cautious. But I don't think that it's for 2022 is already in the cards. So I'd be more cautious, seeing what happens in 2022, and then making the predictions for the following year. But so far, I would still be, I mean, for an economist, fairly optimistic for next year for a 60-40 portfolio.
Well, if an economist is optimist, I think we all have a case for optimism. We'll move to the next question. I hope that answered the question to whoever asked. The next question is, do you think the Fed tapering and interest rate increases have been discounted by the market to some extent already? Faris, would you like to take a go at that?
Well, that's a difficult question, obviously. Let's just take a step back and look at valuations for a second on global equities. Remember where we come from. In March 2020, when we had this huge correction in the markets, we had the situation where global equity, the MSCI All Country World, was trading at 13, 14 times. Okay, then it was followed by 9 months of very strong market performance and EPS cuts at the same time. That exacerbated the multiple expansion up to 20 times in January. So that's where we come from, 20 times PE in January 2021, as opposed to the long-term average of 16 times. So quite a hefty premium. However, during the course of the year, we had this very strong EPS growth, which resulted in a multiple compression from 20 times to 18 times. That's where we stand today on the MSCI All Country World. That's still above the long-term average, and that could still be considered as expensive by some investors. Now, if we write about this 50% that it realizes at the end of the year, and then we have 15% EPS growth next year, this multiple of 18 times will fall back to the long-term history of 16 times. So does the market already discount the tapering? That's difficult. You can also have a situation where markets all of a sudden realizes there is no more insurance from the Fed with liquidity with the markets. You have some negativity surrounding risky assets, and then you have this multiple falling below the average. It never moves in a straight line. It's like moving in spikes. So you can also live in a world where equity will trade at 14 times at some point next year. But our conviction, that being said, is that as market realize that the insurance that is provided by the Fed has not gone away, it's just normalization of an abnormal situation, but that the Fed will actually always be speaking how they would act if needed. So this insurance is still there. Then I think we have pretty good chances that past this trauma or past this scare, we go back to the long-term average of 16 times before the end of next year. So that goes back to what I said before. It's not going to go in a straight line in 15% return for investors. There will be some volatility episodes next year, notably around the tapering announcement. But as the market realizes that liquidity is sufficient for the economy to work, for banks to continue their lending activities, for consumers to spend, then we should regain this historical valuation of 16 times and have this 15% total return. I hope that answers the question.
I think it does. There's a lot of numbers, but at the end of the day, I think what
Faris
is trying to say that the markets will go up. So
yeah, 2018, 16, perhaps over 15 below, but getting back to the average at the end of 2022. That's our view. That's how we simplify it.
Okay. Thank you, Faris. We have a last question for the day. As an investor in equities, where do you see wealth creation in the next 10 years, in the developed markets or in the emerging markets? Or it could be both, So Neelam, would you like to take that, please?
Interesting question. I would say it's going to be a combination of the two. It's very important, like Faris has been reiterating, that it's all about value creation. It's all about handpicking the companies that have seen value created over a period of time and which have positive cash flows generated possibly over the next 3 to 5 years, which have actually been resilient in this market, in the pandemic. For us, what's important is that we look at companies which show those, or I would rather say funds that show companies that have strong earnings growth over a period of time, which have actually sustained. Our screening process in terms of identifying any particular fund is based on a huge number of criteria. And earnings is, I think, one of the most important criteria that we follow. We feel that companies which keep earning well or maybe show a huge amount of growth would continue to actually outperform the rest. Emerging markets have a lot of stars. I think Indian markets have been the star performer. Nobody would have thought that Indian markets would perform this beautifully over the last 18 months or so. So emerging markets, I think India is a favorite. China, we're going to be cautious. On the developed markets, again, US equities, as the poll also actually cleared that US markets are going to go higher. We're looking at a lot of growth coming in from US. Japan, we're going to be neutral. China, we may go neutral till the time the authorities and the regulations are not clear. A lot of news is coming out of there, which is not very positive. We await to hear what the authorities look at. So over the next 10 years, I think it's going to be a combination of both the developed markets and the emerging markets in the equities portfolio. And active rebalancing is going to be the theme. So I would say it's going to be a combination.
Thank you, Neelam.
That answered the question.
Yes, I think I would like to hear Faris's views also on this, on where we can see wealth be created in the global markets.
Well, you've understood by now that I'm a little obsessed with value creation as measured by cash flows, and we have quite consistent and stable candidates over the past decades, plural, when it comes to value creation. I cited some of these geographies that also Neelam mentioned. So on the emerging market side, India stands out. It's a country with very high, with companies with high margins, low capital intensity, notably in the tech sector. The discount rate, the market-derived discount rate went down because valuations went up. So one has to be a bit careful about which stocks he picks in India, because valuations sometimes are quite scary, I have to confess. But in aggregate, it's a high value creation geography, and I would definitely keep an overweight in the global equity portfolio. On the developed market side, I cited the name Switzerland, Nordic countries like Sweden, Denmark, and the US. Those are the 4 geographies that stand out in terms of value creation. And the common denominator of these companies belonging to these countries are high research and development, so which measures typically innovation, high entry barriers, strong brands, and high and sustainable value creation over the long run. And we like these companies with such profiles because they typically outperform when markets go down. So they have lower drawdowns because of these defensive cash flows. And they more than participate in market rallies because they have some sort of innovation that keeps them exposed to structural growth trends. So we like this asymmetry of returns by selecting high and sustainable value creative companies and countries. And yeah, that's more or less how we would put it. India on the emerging market side stand out, and on the developed market, Switzerland, Nordics, and the United States.
Thank you, Faris. I think we've almost run out of time, so I would like to thank all the panelists and the audience for making this webinar successful. I think some of the takeaways that I had from this was optimism, value creation, and that our panelists don't agree with our audience's view on inflation. So we can only hope for the best, and I think we are looking forward to a great year next as well. Thank you, everyone. Thank you for joining us. And if you have any questions that you have further, please feel free to write to us.
Thank you.
Thank you.
Thank you, everyone. Bye-bye.
Bye-bye.
Thanks, Abhishek. Thank you.
Thank you.